There is no shortcoming of bad tax advice on social media. I see it day in and day out, and I even see it in conversations that I have with my clients. They'll come to me with some myth or some tax advice that they saw on social media that is actually pretty far from the truth. The first one is that you need an LLC to save on taxes. At the end of the day, an LLC is not a tax savings vehicle. All it is to limit your liability. So whether you're an LLC or you don't have an LLC, you have the same tax advantages to be able to write off the expenses that relate to that self-employment income. Sure, once you're an LLC, you can look into be taxed as an S Corp or C Corp, etc. And in those situations, that might make some tax differences. Let's say you have a $10,000 expense related to your self-employment income. Whether you have an LLC set up or you don't, does not change anything about taxes. The second one is that a $10,000 business expense saves you $10,000 on taxes. I cannot tell you how many times people tell me this. They say, hey, I just went and bought this. It was $10,000. I'm gonna save $10,000 on taxes. This is a really great idea. I'm sorry, it's not how it works. What they're referring to is a tax credit. Very few things out there are tax credits. Most are tax deductions. Tax deductions save you by the expense times your marginal tax rate. So let's say you have a $10,000 expense, you're in the 24% marginal tax bracket, you're gonna save $2,400 on taxes. This is great. At the end of the day, you're still saving money on taxes, but at the end of the day, you're still paying $7,800. If you save $2,200 and you spend 10, right? You're spending $7,800 still. So really look at it as a discount. If you were gonna buy that item or do that thing in your business, this is great. You basically get it as a discount. But if you're just buying it to save on taxes, you're costing yourself money at the end of the day that you don't have to be spending. The next one is that if you own a business and you buy a $50,000 car, that is gonna save you $50,000 on taxes. Again, very similar to the last one, but this is not how it works. How it works is first you need to know, is this a business vehicle? If you're like me, you work from home, probably not gonna have a business vehicle. You need to be spending well over half the time using that vehicle in the business to really write this off. So there is a way where you can basically bonus depreciate the car. So $50,000 this year, you can bonus depreciate 60% of it, which is $30,000. And then you get that as a write-off if you use it for 100% business. If it's 50% business, then now that $30,000 write-off becomes $15,000. So if you're at the 22% tax bracket, it's gonna save you 22% of $15,000. So nowhere close to $50,000. The other part about this is many people don't do this, right? If you're driving to your office, that doesn't really count. It only is driving outside of like those normal activities. So certain businesses, this does make sense. It does work. But at the end of the day, it's not a tax credit. It's only gonna save you based on that percentage. But for a lot of people, they're not gonna hit these requirements. So the other item that you can do is you can basically just write off the mileage. So if you're driving 1,000 miles, you get to write off 1,000 miles times by the yearly rate on what gets to be written off for mileage. The next one is that if I convert my cryptocurrency to another cryptocurrency, it's not taxable. So if I move from ETH to Bitcoin and Bitcoin back to ETH, it's not taxable. At the end of the day, this is not true. So how the IRS views this is that these are all sales. So I had ETH, I sold it, I bought Bitcoin. I bought Bitcoin, I sold it, I bought ETH. All of those are taxable events. Even though you can do currency conversions, in the eyes of the IRS, those are sales. So at each point, you have a capital gain or a capital loss that you need to be able to plan for. These conversions are taxable events. The next one is that filing an extension means that your tax liability is due later. So everybody knows April 15th is when your taxes are due, but you can extend to October 15th. A lot of people believe that if you do that, then you don't have to pay your tax liability to October 15th, but that's not the case. Regardless of whether you file or extend, your tax liability is due on April 15th. If you don't pay it by then, you are gonna owe penalties. So you wanna make sure that you are doing this and you're planning for it well. The next one is that if I leave money in my business, then it's not taxed. This isn't true. So the only time that this is somewhat true is if you're a C Corp. So if you're a C Corp, profits the business are taxed at 21%, and then you get taxed again if you distribute it to yourself. But every other type, sole prop, partnership, S Corp, they're what's called pass-through entities. So regardless of whether you take that money out or leave it in, it's taxed to you. All of the profit of that business flows through to your tax return. Taking it out of the business doesn't add any more in taxes because you did that. This is so common. I see business owners keeping a ton of money in their business, not deploying it or using it because they don't want to have to pay taxes, when that's just not how it works. The next one's about real estate. Time and time again do I see people say, oh great, I'm gonna buy real estate, I'm gonna have these losses, I'm gonna use these losses to offset my active income. And if it worked like that, that would be awesome. But it really doesn't. There's only two ways that you can use the losses of real estate to offset your business income, your W-2 income, etc. The first one is if you're a real estate professional. So if you're a real estate professional, then you can use these losses, you can do cost segregation studies, bonus depreciate it, and use that to offset your taxes. But to be a real estate professional, you need to spend 750 hours or more in real estate business per year. And it has to be more than 50% of your time. So if you have any other job where you make a good amount of income and work quite a bit, you're not gonna end up qualifying. It's something that a lot of people don't know. And so you don't wanna go into this thinking you can use these losses, but those losses can only go and offset other passive gains. The other part of it is you still have to materially participate in those properties. So that's one test. The other one is that you actually have to be the one doing the work. So the other way to get these to be active is by short-term rental loophole. Basically what this means is that you have a short-term rental, you don't spend more than 14 days per year in this property, the average stay is under 7 days or less. If you do that, then you also have to participate in that property. So what that means is you have to spend 100 hours or more on that property. You have to do more work than anybody else. So if you have an Airbnb and the cleaners are spending 200 hours and you spend 100, you don't qualify. And these are things you really want to get right. You need to log the hours, you need to be able to prove it. This is highly audited by the IRS, but it's pretty hard to pass these tests to be able to use these losses to offset your active income. The next one is that you can set up a Roth IRA for your baby. Time and time again do I see business owners say that, hey, I paid my baby $12,000, I was able to contribute to a Roth IRA, and you ask them what they did and they said modeling. You're like, oh great, what modeling? Oh, we took some pictures for our website. Oh, how long did that take? 3 hours. Okay, so you're telling me you spent $4,000 per hour for your baby? The IRS looks at this as reasonable compensation. What would it be reasonable to pay somebody else? And that's just not gonna work. So at the end of the day, you can't really do this with babies unless somehow you have a business and your baby's in it and has a ton of hours. In general, this is something you can start to do as they get older and they can do real work. It's not something that you wanna risk and get in trouble for because you aren't doing reasonable work with your child. The next one is that all capital gains are taxed the same. Oftentimes, people think no matter when you sell your investment, you're paying capital gains rates. It's a brokerage account, right? That's how it works. Wrong. If you buy an investment and sell it within 1 year, you pay short-term capital gains rates, which is the same as your income. If you hold it for greater than a year, then you pay long-term capital gains rates, which are 0, 15, or 20%. And then when you have over $250,000 of income, you also pay 3.8% net investment tax. But typically long-term capital gains are quite a bit lower than short-term capital gains, which is why people really love brokerage accounts. And then the last two are really about equity compensation. So the first one is that I need to hold my RSUs for longer than a year to avoid paying short-term capital gains. At the end of the day, when you get RSUs, those are taxed the day they vest. So let's say it's April 15th, I just got $100,000 of RSUs. That is taxed to you as income on the date of the vest. They're gonna sell some shares to help cover those taxes. If you're a high income earner, this might not be enough. But at the end of the day, if you sold those the next day, you're not gonna owe taxes other than the tiny bit of growth or loss that happened in that period of time. If you choose to hold on to them and you sell in 6 months, yes, the growth or the loss there is short-term capital gains or loss. And then if you wait a year, you get long-term capital gains. But oftentimes people choose to hold a year after invest, thinking it has the tax benefit and not realizing that it's basically a cash bonus and you're choosing to hold that stock and buy that stock when you could have moved out of it without paying any taxes. And then the last one is that you don't pay any taxes on options as you exercise them. So this isn't true. There's two types of options really. The first one is ISOs, incentive stock options. How ISOs work is that you choose to exercise. So let's say you can exercise at $10, the market price is $20. So you have a $10 bargain element. So that $10 difference is not taxable to you unless you trigger what's called AMT, the alternative minimum tax. If you trigger AMT, then you're gonna pay 26 or 20. But the other type is NSOs, non-qualified stock options. With non-qualified stock options, you do pay taxes on the exercise. So let's use that same example, $10, current price is $20, you pay income taxes on that $10 spread. So let's say it costs you $50,000 to exercise these options, and that all of them have a spread, so you have another $50,000 that come as income taxes. That can be a lot. It's definitely something that you want to plan for and be aware of, potentially even pay a quarterly tax estimate for it. So at the end of the day, this is some of the most common tax myths that I see on social media. Hopefully this helps clear up a lot of things for you, so you will not fall for a lot of this bad advice. Thank you for watching. If you enjoyed this video, please leave a like and go subscribe to my channel for more personal finance content. And as always, please leave your thoughts in the comments below, and I promise to get back to every single one of them. We'll see you back next week.